Anyway, joining us right now to talk about what all of these headlines out of Washington mean for corporations and for investors is Don Schneider. He's an economist at Cornerstone Macro. And Don, let's break this down just for individuals first, what this is going to mean in terms of the taxes they're paying.
Sure. If you're a wealthy filer earning above $400,000, your taxes are going to go up. Generally, it's about the wealthiest filers, about a 5% reduction. Their after-tax incomes or a 7 percentage point increase in their effective rates. If you're earning, say, below $50,000, you'll see about a 4% boost in your after-tax income. So the general pattern we see is rates going up at the top, and then we'll even at the very lowest end of the income scale, you'll see negative effective tax rates.
Corporate rate, we know, is going to go up, and we know there's still discussion taking place about this. But maybe one of the things that gets looked over a lot is the pass-through corporations. They're going to take a big hit, right?
Yeah, absolutely. That's something that, for example, President Biden didn't propose very much on in his plan. But then the Ways and Means Committee added a lot more. The top rates on pass-through businesses could go up somewhere between 13 and 16%, their marginal rates. And that happens for a number of reasons. First, the plan would basically cap what's known as the 199A deduction, the pass-through business deduction. That's effectively a 7.4 percentage point marginal rate increase right there. There's a 3% AGI surtax that would kick in. And then there's an increase in the top marginal rate, as well as an expansion of the net investment income tax, a 3.8% tax to certain pass-through businesses who don't pay it. So add those all up, and you're looking at somewhere between a 13 and 16 point increase in rates for pass-through businesses.
You know, you mentioned that Biden didn't have that in his original plan. There was a lot of coverage about how there were so many more pass-through corporations and that they were managing to avoid taxes. Is that why they kind of went after this, because that's where a lot of money is now?
Yeah, I think so. Relative to Biden's plan, the Ways and Means Committee significantly scaled back some of the corporate tax increases. For example, the GILTI, one of the foreign international minimum taxes, that had a 26.25% rate under Biden's plan. It's now 17.4 in the Ways and Means Committee bill. So they really scaled back on the corporate side, even though they still have about $1 trillion in tax increases on corporations. And they scaled up some of the taxes on pass-through businesses. And on net, that's left them with about $2.3 trillion in tax increases over the next decade.
Let's talk about what this means for different industries, because that's where investors are kind of honing in, trying to figure out if there are arenas that are going to get hit harder or maybe those that benefit. One of the clear beneficiaries, as you point out, is the clean energy stocks. What do you kind of take a look and see with that? Because actually not all clean energy stocks are equal with this. There have been already Elon Musk and Toyota raising a little bit of a ruckus, raising concern that the EV benefits that you get from this have to be from cars that are built in America with union labor.
Yeah, that's right. The bill, through a variety of sort of tax credits, would generate about push about $270 billion in revenue into various clean energy across a range of sources of energy. That said, there are limitations, whether it be on the content requirements or otherwise. I think those have some chance to be worked through, whether it be in the Senate or with negotiations within the House. So it's possible that those will be addressed. I would say, of course, clean energy is probably one of the biggest winners from the tax perspective here. In terms of, the losers, corporations writ large will see higher taxes as a result of the 26.5 rate. But maybe some of the most concentrated losers will be in the tech and the pharma space. Businesses who are operating abroad have their intellectual property held overseas and are going to see an increases in their rates abroad, as well as a broadening of the tax base, predominantly through GILTI. And
if none of these details are finalized yet. So if investors are actually thinking about making moves, trying to game the system ahead of what's coming, what would you advise them? Which ones look like they are pretty ironclad?
Well, so it's interesting. Of the bill right now, as it stands, they're spending more than $3.5 trillion, according to our estimates, which is above the $3.5 trillion notionally supposed to be supported by the budget. And they have about $3 trillion in offsets, about $700 billion from drug price negotiation and other savings, and then 2.3 trillion in tax increases. Earlier in the show, you were talking about limitations that cinema and mansion might put on the bill. Let's say they scale back revenues to around 2 trillion. They've already proposed 2 trillion in revenue, so there may not be much that is getting scaled back on the tax side, maybe to 1.5 trillion, which is the upper bound for Senator Manchin reportedly. So, there is probably not a significant amount of changes that will occur. I would say notably the corporate tax rate might be scaled back to 25%. The foreign international minimum tax could go from, say, 17.4 to somewhere closer to 15, like 16.4, for example, which is where it would be under the Republican tax bill in 2017. On the individual side, you might drop the 3% AGI surtax, a few other things here and there, but I don't think you're going to see very major changes on the tax side of things.